Don Yacktman is sticking to his guns when it comes to buying big stocks. Now, this might be why the Focus Fund is still a Bloomberg best in the U.S. Diversified Equities Fund category, beating 98% of its peers over 5 years. Don Yacktman, President and Chief Investment Officer of Yacktman Asset Management, is joining us now from Austin, Texas, with his outlook for the new year. Don, thanks so much for joining us this morning. We know that two of your biggest holdings in your Focus Fund are Microsoft and Pfizer, so you obviously like the big stocks. But as a group, they didn't do so well this year. Why is this strategy going to pay off in the new year?
Well, I think I have to preface this by talking about our strategy, which is to protect our clients' money and make money and beat the index over a cycle, a peak-to-peak cycle. Excuse me.
So not necessarily a calendar year.
Right, exactly. We take a very long-term view, and like over the last 10 years, I mean, the index is down, we're up dramatically, and I think we've compounded money at about 13% ahead of the S&P. With that said, and we buy individual stocks, the place that we find the sweet spot are these large, profitable, what maybe someone would call blue chip type companies. Pepsi and News Corp are actually bigger holdings than Microsoft and Pfizer, but they all represent the same kind of strategy. The reason they look good going forward is because they haven't done well going backwards in the last year or so. And so if you look at the risk-adjusted forward rate of return compounded over several years, these are the places we find the best values.
So on a valuation basis, you're saying you can get a quality name for a fairly low price. Strategically, though, for these companies, a lot of the ones that you just named, the four we're talking about, do have a lot of cash on their balance sheets. What if they can't find a way to use that going forward? I mean, how does that affect their price, their stock price, and then whether or not you want to invest?
Well, one of the options they could use is buy back their stock, and when it's cheap, that's a great use of cash. And with interest rates where they are, I think they'd get a lot higher return by buying back their stock anyway.
Don, what about the idea that some investors talk about coming out of a recession or coming out of a slow economic time, that small caps often perform better than the larger names? Do you say that's true, or is that just a myth?
Well, I think what happens is people look at the relative change in margins, and margins certainly on more marginal companies will increase on a percentage basis more because the stronger companies tend to have very little change in their profit margins. So I think that's why the cyclicals and probably a lot of the small companies have moved real well. But again, I think one should not, you know, if I'm driving a car, I find it's much more efficient to look out of the windshield rather than the rear view mirror.
Yeah, that's a fair point, Don. What do you see ahead? I mean, there's been so much talk about where exactly the U.S. economy stands, and of course that affects any investor's decision. Are you fairly optimistic that we've seen the slowest times behind us and that 2011 is going to be a strong year for the stock market?
I just, you know, the economy or the stock market, we just don't spend a lot of time talking about. I will say this: if you take out all of the financials, or look at the fact that so many financials have been taken out of the S&P index, Fannie, Freddie, Washington Mutual, Countrywide, Bear Stearns, Lehman Brothers, then the dilution of like Citicorp, Bank of America, etc. There's a huge chunk of the index that's eliminated, and so the index is a lot higher today than it would appear at face value.
So essentially, there's a lot of good deals out there. Don, thank you very much for joining us. Don Yacktman joining us. He is Yacktman Asset Management, as you heard there, the CIO.